Swayam Prabha. Digital India. Educated India.
Welcome to the next session on commodity derivatives and risk management. If you recall, in the last session we were discussing about the traditional price risk management avenues for Indian farmers, and we discussed how crop insurance, contract farming and minimum support price mechanism of Government of India has been used by Indian farmers, and we were discussing how CACP, that is Commission of Cost and Prices, Commission of Agricultural Cost and Prices, CACP, announces what is going to be the minimum support price for different kind of agri-commodities couple of years before, so that the farmers get to know, if they go ahead and produce this agri-commodity, what is the minimum price they are going to get. And CACP considers various kinds of factors before it decides what is going to be the minimum support price. And who are the bodies which help Government of India in procuring these agri-producers from farmers? So these are Food Corporation of India, and you have Cotton Corporation of India, you have Jute Corporation of India, and you have NAFED and Tobacco Board. So these are the five government bodies which function as the procurement agency for Government of India, and they pay minimum support price to the farmers and buy the agricultural commodities from the farmers. Now let's go to this today's discussion, that besides these three pricing traditional price risk management mechanism, a need was felt for providing a market infrastructure by which farmers will be able to mitigate the price risk. That is the reason why we discussed some initial sessions, the reasons behind the reintroduction of commodity futures exchange in India. And since the inception of this commodity exchanges in India in the year 2003, Indian agri-commodity derivatives trading has grown significantly. In fact, we have MCX and NCDEX. MCX is predominantly known, or it has got a major market share in metal futures contract. However, NCDEX has the largest share in agri-commodity futures trading in India, and which are the most active agri-commodity futures contract trade at NCDEX. You have cotton, barley, chana, coriander, cotton seed, oil cake, guar gum, guar seed, soybean, etc. And this particular graph which you can see, it shows how the quantum of commodity derivatives trading has gone up year on year since the year 2003. This data is pertaining up to December 2015. So if you can see, it achieved a peak during 11-12, and it has gone down little bit. However, considering the quantum which has been mentioned in the y-axis, is substantially higher. Now let's take some examples how different commodity agri-commodity producers and commodity consumers have used this NCDEX platform or MCX platform for mitigating that price risk. We have discussed many a times that a party who is long on asset and is fearing that price is going to go down in future, that party will be able to mitigate the price risk by entering into short futures contract. So agri-commodity consumers who are short on underlying will enter into long futures contract if they are fearing a price increase. Similarly, agri-commodity producers who are fearing that price will go down in near future, they will be able to enter into short futures contract if they are fearing the price is going to decline in near future. In fact, in this context, I would like to share a very good initiative which has been taken by National Commodity Derivative Exchange, and this is a case study which is available at NCDEX website. This is the Rahim Pragati Producer Company Limited. So this is a producer company, and many small farmers have joined hands to form a producer company, because if you know, a small farmer may not be educated enough, a small farmer may not have the necessary skill set, may not have access to trading platform, and may not have the amount of minimum trading lot required to enter into a futures contract. So by forming a producer company and by aggregating the produce, they are using this exchange platform to hedge commodity price risk. So this Ram Rahim Pragati Producer Company Limited has taken a membership at NCDEX, and they are using, this particular company is using the NCDEX platform to mitigate price risk associated with various types of commodities, specifically with respect to maize. So this when I visited the company's website to understand more about how this company is leveraging NCDEX platform to mitigate the price risk of the small farmers, the company website mentioned that the company is first emerging as one of the India's largest producer-owned agri-value chain company. I want all of you to focus on the word producer-owned. So this is a company whose ownership is with the producers, and one of the India's largest producer owned agri value chain company, working on soybean, maize, pulses, wheat and millets by helping farmer adopt the non-pesticide management protocol. And it is also the first producer owned company to become a listed member with the NCDEX. So this as per the information available in the company's website, as well as popular news reports from the web, it shows that using the NCDEX platform, these farmers have been benefiting and they are able to mitigate the price risk associated with their produce. So I have given the link to this particular company here if time permits, or if you are more interested on how these small farmers are going for an aggregation model to mitigate the price risk, do spend some time. Now question comes to, what about other value chain partners? How do they mitigate the price risk? You have commodity producer, agri-commodity producer, they enter into a short futures contract. Agri-consumers, they enter into long futures contract. But what about the value chain partner? Let's say a wholesaler or an exporter. Let's take an case of an exporter which is into export of various spices. So what the exporter does is that it buys spices from the open market and exports it to different parties or different countries. Let's say let's say if this particular export house has already holding the inventory and does not have any fixed sales commitment, that means it has already spent money buying the spices, but it does not have a fixed order to whom it is going to sell, to whom it is going to export, and at what price it is going to export these spices is not, it's not yet firmed up by the company. So in the meantime, if the spices the prices of spices goes down, the company incurs loss. Also, the company, in the meantime, the company must have spent considerable amount of money in storage, insurance, packaging costs. So in that case, how the company will be able to mitigate the risk? The risk associated with this long position in the underlying spices can be mitigated by entering into short futures contract. So in this case, the wholesaler or the exporter can enter into a long futures contract. As and when it gets an export order, it will be able to deliver the underlying deliver the spices to the buyer and square up its short futures position. Now let's take the next situation. Let's say the exporting house or exporting company has a firm export order at a fixed price. It has agreed to deliver, let's say 300 tons of some spices to some exporter based in Dubai. However, this Indian export house does not have the inventory in its hand, and if it goes to the market on a given day, it may not get 300 metric ton of spices at a reasonable price. Even if it gets a price at a reasonable 300 metric tons of spices at a reasonable price, it may not get the desired quality. So how the exporting house will be able to mitigate the risk in this case? So instead of going for a bulk purchase on a given day, the export house can enter into a long futures contract, and as and when it starts aggregating or buying the spices from the open market, it can go on squaring up its position by taking a short futures contract. So let me summarize what I just mentioned. A middleman or a value chain partner may be a long on asset or may be short on asset. When the export house is holding inventory without any fixed sales commitment, it is long on asset, and it will be able to mitigate that risk by entering into a short futures contract. Similarly, when the same export house has a firm export order but it does not have the underlying inventory in its hand, it will be able to mitigate that risk by entering into long futures contract, and as and when it buys the inventory from the spot market, buys the spices from the spot market, it can start squaring up its long futures position. In that case, in both the cases, it will be able to at least protect its margin by entering into the futures contract. So in fact, there is a company called PC Kannan and Co, which hedged its coriander prices at NCDEX. So you can visit the link provides how this PC Kannan and Co hedged its coriander price risk at NCDEX. It's a very beautifully prepared document, and you can spend some time to get an understanding of how in real life company use this exchange platform for mitigating price risk. Now let's go to one of the very important aspect of forming views about future price. We are discussing, or we are many times I am mentioning that a farmer is fearing the price is going to go down, or a consumer is fearing price is going to go up. But how that fear, what is the basis of the fear? There has to be some analysis, some basis based on which the farmer will say that there is a chance of, there is a greater probability of price going down in future. So it requires understanding of the whole supply demand, who are the major consumers, who are the producer, what factors, global, local factors, which may have a bearing on the price. So understanding that is of for a particular agri-commodity is of paramount importance before we take a decision, or a consumer or producer of that commodity takes a decision regarding whether to hedge the risk or not to hedge the risk. Now, with respect to agri-commodities, how we can form a view about whether price is going to go down or price is going to go up in near future. So what are the factors which affect the agricultural prices of agricultural commodity? Let's go to the screen which is in front of you. So if you see, these are the points which is mentioned. One is one of the important factor is the acreage of farming. So what has been the how many hectares has been used for plantation of that crop. So that is a very, very important indicator of what is going to be the total likely quantum of the production if everything else remains constant, where the parameters do not change. So this is one of the most important fundamental factors which must be considered if we are going to form an opinion regarding whether price is going to go up or go down. Then with respect to price, we also have to consider whether there is seasonality in production of that particular commodity or not. In fact, most of the agri-commodities have some seasonality incorporated into incorporated into the price, because most of the agri-commodities are either produced in Kharif season or Rabi season. Of course, there are some commodities which are getting produced in both seasons because of the advance in agricultural farming techniques and all, but those commodities are not that common. So there is going to be definitely seasonality in production, and whenever there is seasonality in production, there is going to be this seasonality is going to be affecting the price. And we know mostly during the pre-harvest period, prices of agricultural commodities tend to go up, and post-harvest period, prices of agricultural commodities tend to go down. Of course, the decline of post-harvest period depends upon the availability of warehouses or storage. So if enough number of storage or enough warehousing capacity is available in an economy, then the farmers don't have to go through the distress sale, and agri-commodity prices may not plunge substantially. In fact, many times you must have read that particular agri-commodity prices are ruling so low that the farmers are not interested to go and extract the farm produce, or harvest the farm produce from the field and take it to the nearby market, because the cost associated with extracting or harvesting the agri-commodities, packing, sorting and bringing it to the local mandi is far higher than the price prevailing at the spot market. In fact, a couple of years back, you may have read that tomato prices, the farmers were throwing tomato in the roadside, farmers were throwing potato in the roadside, or farmers were even not, harvesting onions from the field, because if onions do not get harvested within some number of days, it starts rotting. However, the cost associated with harvesting onions, as well as packing, sorting and grading and taking it to the nearby mandi, was higher than the onion prices prevailing in the local market. So if enough amount of cold storage or warehouse is available, this kind of situation may not happen. So seasonality or decline in prices, post harvest prices, may not be substantially lower if enough amount of cold storage is available. Now let's go to the next factor. So there is a seasonality in consumption. Consumption pattern can also have a seasonality incorporated into it, and if a particular commodity is demanded, highly demanded during a given period of time, that price tends to go up during that point of time. However, one thing I would like to sensitize all of you here at this point of time is that there is nothing called seasonality in consumption of agri-commodities anymore. Why? With the availability of food processing industry, we are consuming all agri-commodities almost throughout the year. In fact, if you recall, there would be earlier in India we used to, specifically in the North India, the dry fruits were eaten predominantly during the winter months. But nowadays, if you go, the consumption of dry fruits is fairly smooth. Maybe during pre-Deepavali, little the prices may be going up little more, because during Deepavali, lot of people start giving each other dry fruits. So that could be the reason of little extra consumption during that period of time. However, if you see throughout the year, the consumption pattern is quite stable for most commodities. And this is also corroborated with the fact that we are consuming more and more consumption, per capita consumption of everything we are, as a human being we are doing. If you know, according to the WHO, the total obese persons in the world, with the increase in population also, so it has almost doubled. We have population increasing, and with that also the obese people, the percentage of obese people has doubled since last 15-20 years, and 15% of adult population all over the world are considered to be obese. And also one thing, on a lighter note, I would like to share is that female are more obese than a male population. So anyway, I don't want to discuss any more about it. So what I am basically driving it is that though seasonality of consumption could be a factor for increase in prices for certain commodities, but that probably is not that big a factor. So consumption, higher consumption led price increase may not be a factor for agri commodities. We have already discussed availability of storage facility. Another important aspect which influences price of agri commodity is the export-import linkages. So if a country is open to export its agri commodities to other countries, or it is open to import agri commodities into the country, then the commodity prices do not exhibit that kind of or that significant volatility. So whenever the local price increases, there will be export houses or export import houses who will be bringing the commodities to the country, and whenever foreign country the price increases vis-a-vis the domestic prices, they will be exporting those cheaper commodity to the other locations. So if a country has export import linkage for agricultural commodities, that country prices at that country may not be exhibiting higher seasonality. Also, another aspect, which is the regulatory factor influencing future spot price. As we discussed, even if many times the supply demand situation should be such that there should be great amount of variability, however, many times government of a country ensures that there is not much of a volatility or price fluctuation in certain commodities. Government mechanism ensures that the price change or price volatility remains within certain label, and this specifically, let's take an example of Government of India. If you recall, we discussed about minimum support price in the previous session. So the minimum support price ensures that the farmers get some base amount of price. So even if there is a bumper production for a particular commodity, price does not go down substantially, because the minimum support price ensures that the farmers are given some basic price. So when a farmer is getting this suppose X amount of price, any other party has to pay little more than X price to buy the goods for the farmer. So minimum price prevailing in an economy will be, or the floor price will be, the minimum support price. In fact, Government of India has Essential Commodities Act, in which Government of India, the central government, regulates the price of certain essential commodities, and if price goes up substantially higher, it undertakes different measures so that the price rise is curtailed. So with this, we will come to an end of this session. So what basically we discussed in this session is how commodity producers, consumers and value chain partners are able to use the exchange platforms to mitigate the price risk. We discussed also about how even small and marginal farmers, how they have formed producer companies, and at a collectively they are able to go to an exchange platform and mitigate price risk, which otherwise would not be possible had they been operating on an individual level. We also discussed about what are the factors which could have a bearing on the spot price prevailing for a particular commodity, because the spot price influences what is going to be the futures price prevailing at futures price for that commodity. So with this, we will be ending up this session. In the next session, we will be discussing more about how seasonality, how can we go ahead and identify seasonality, and how seasonality influences the price of a particular agri commodity. Thank you, all of you.